to...
Welcome back, everyone. I'm Rob Booker, best-selling author of Adventures of a Currency Trader. I bet you're tired of hearing me say that. I think I'll stop doing that. We talked about pip value. We talked about account sizes. We talked about a bunch of stuff. We are going to talk about what those trade sizes mean and how much money each pip is worth. Before we do that, I want to talk about FX spreads and commissions. This is the way the broker makes money, is by charging a spread and in some cases charging a commission on each trade. Now, when you pull up your trading account and you pull up the quote window and you're about to take a trade, on the right side is the buy price and on the left side is the sell price. And I'm going to look at it on the slide so you can see it even better. So if you're looking at a quote for the US dollar Japanese yen, it might look something like what we're seeing on the chart right here. 106.90, 106.92. Now the price at which you can buy it is over here on the right. They might call that the ask. I just call it the buy price, because if you hit that price, that's the price you can buy it at. Now if you buy it at 106.92, you can immediately sell it at 106.90. Now if you buy it, Nate, at 106.92 and immediately sell it for 106.90, have you made money or lost money?
Lost.
You've lost money. That's because the broker charges a spread. You're going to start your trade off at a loss. The broker got the dollar Japanese yen in their inventory for 106.90, and then they're letting you buy it from them at a markup of 2. You may actually hear the term markup in the world of FX dealers. That's a word for spread. Markup. If you sell a used car to a used car dealer and then they sell it to someone else, they buy it from you, they mark up the price, and then they sell it. That's the markup. The spread is the markup. It's the way that the dealer makes their money. Okay, so when you're reading a quote, you can hit the buy price at 106.92 thinking the US dollar Japanese yen is going up. And then you can wait till these two prices start to climb, and then you can get out of the trade at hopefully what is a higher number later on than 106.90. That's the spread. You always have to pay the spread. That's the cost of doing business in currency trading. Now there are times when a broker, and I'm going to use C as the terminology, may give you a tighter or lower spread so it's easier to get your trade into profit. They may in fact give you a spread of 106.90 and 106.91. That makes it easier to get your trade into profit much more quickly. The market doesn't have to move as far. They may do that by charging you a commission, a small commission on each trade equal to a fraction of your trade size. And it's usually very reasonable. And it's not a problem that a broker or a dealer offers you an account with a commission. That can give you a tighter spread, better execution, and it's not a bad thing. But that's how they make their money. They make their money by charging you a spread and in some cases a commission. So the spread on the euro US dollar might look something like this, 1.2900. And this, if you hit this price, you can sell it or bet that it's going to go down at that price. The spread on a euro might be 3 pips higher. So if you sell it at 2,900, you are immediately going to be, in this case, Nate, how many pips down will you be immediately?
3.
You'll be down immediately 3. So it's not uncommon for you to see a small loss in your account when you first take that trade. And that's fine. In order for a sell trade, if you initiate a sell trade, you're just betting that this euro dollar is going to go down. That's all you're doing. And if it falls, both of these numbers are going to drop. And this is the price you can hit to get out of your trade. You got to buy it back. If you sold it to start, you got to buy it back. And if you bought it to start, you got to sell it to get rid of it. And that's just how this works. You're betting that something's going to go down on this side, and you're betting that something's going to go up on this side. And there's always going to be a difference between those two prices, and that's the spread, and that's how your dealer makes money. Now, people talk about tight spreads as a reason to trade with the dealer. Generally speaking, most of the spreads are going to be very similar. across all the FX dealers around the entire world right now. Here's a little nugget of wisdom that most people won't talk about. There's so much money inside of the spread. There might be 2 pips, there might be 3 pips, there might even be just 1.5 pips. The spread's going to be that wide. These brokers will, in some cases, pay out rebates. And sometimes I'll talk to Nate here because he's sitting with me. Hey, Nate.
Hello.
And a rebate is a little bit of the spread returned back to the customer in exchange for opening up the trading account, or returned back to someone who referred the customer in order as it's a little kickback. So there's money built into the spread for the dealer to compensate its partners or even send money back to you, and those are called rebates. So you can actually get some of this spread back on a monthly basis even from your FX dealer or from an introducing broker as part of the whole interworkings of all of this. Nate, did any questions come to mind? This is often a complicated topic. Did you think of any questions as we were discussing this?
No, I want to say what is a pip worth, but...
All right, so what's a pip worth? Well, that's our next lesson. So we'll wrap things up here. And as we do, I want to say thank you to our sponsor, Forest Park FX. Interested in FX trading? Contact Forest Park FX to open an account and receive cashback rebates on every trade you place. Go to forestparkfx.com. Forex trading carries a significant risk of loss and is not suitable for all investors. Terms and conditions will apply. I'm Rob Booker. Thanks so much for being here. I'll see you in the next one.